Let's talk about Nigeria's central bank, which just released a new framework for monetary credits, foreign trade and exchange policies for 2020 and 2021. The 143-page document reviewed the policy framework and results for the 2019 period while making some projections for this year and next, especially within the COVID-19 environment. Dr. HASSAN MAHMUD is the director in charge of monetary policy at the central bank, and he joins me now to discuss the latest document a bit further. Good evening, Dr. MAHMUD. It's good to see you.
Good to see you too, Mosun.
Thank you very much for coming. I'm sure 2019 was a tough period, but I'm sure 2020 will be said to be a lot tougher. So what were the learning curve or lessons from the monetary policy round of last year that you're taking on board for the current period?
Thank you very much. I think, let me start from this template. The paradigm has shifted from, the practice, mimicking the theories, from the theory to mimic the practices now. We've seen in the 2019, the trends from the beginning of your, analysis, relatively, 2019 was a good year, given the numbers we are seeing, particularly for the second quarter of 2020. So from the 2019 performance, where growth stood at 1.87 at first quarter of 2020, from 2.55 at the end of 2019, and then getting to minus 6.10 at the second quarter of 2020, it's a clear indication that we're in a crisis period, and if we don't manage to coordinate our initiatives to address the COVID-19 challenges, the situation could worsen off. So what are we taking off from the 2019 years? In terms of the financial sector stability, we saw some initiatives of the central bank relating to credit to deposit ratio. Coming into the 2020, we saw the GSI, the Global Standing Instruction, that was supposed to manage credit risk in the system and how that has impacted on the NPLs in the industry, which is also affecting financial system stability. We've also seen the impact of our interventions in agriculture, in manufacturing. If we had not gotten those consolidations towards the end of 2019, then what we'll be seeing now will be worse than what we're actually experiencing. And that's why it's been said that even at minus 6.10 contraction in the GDP, the projections were actually worse than that. So those consolidations that we had provides a kind of cushion for us getting into 2020. So we are bringing in some of those, what we call unconventional monetary policy tools, given the fact that the monetary policy space and currently even the fiscal space is thinning out. So we need to do those injections to be able to, one, manage the supply side because of the inflation numbers that we are seeing, which are some of them are, supply restrictions that are coming in, and also get the aggregate demand to pick up to support this supply side initiatives that we are doing. So those interventions, agriculture, manufacturing, power, they are all, we are seeing the benefit of those now coming on stream. But don't forget that these are structural issues. So it's not something you see quarter on quarter. It's something you see over, sometime a year, 2 years time. So, the complaints that, okay, you've invested so much on this and we are not seeing the impact. It's not something you get, month on month. There are things that, you see crystallizing over time. And one of them is what we are seeing now that has cushioned this shock that we are seeing. The uncertainties are still prevalent, and nobody's sure of how the thing will end towards the end of the year. But what is important is know the policy initiatives that you are going to direct at this.
Just a quick one about some of the projections that you have. External reserves between $30 and $34 billion by the end of the year. Output growth between minus 3.1 to about 0.24%. Oil prices between 10 and 30. You seem a little bit bullish on the output growth that we could do 0.24%. You're a little bit bearish on oil prices below international averages right now. Monetary targeting strategy will remain, but you said fiscal space will be constrained and external sector expected to deteriorate. So if we look at the policy focus and strategies that you outlined in the new document, do you think they're enough to soft land us in 2020 into 2021?
I think the policy initiatives are evolving, and they are a function of how the economic activities turn out, the economic behavior. They are not static. So as the situations elevate or escalate, so also will the policy initiatives to address them. And as things cool off, so also will be the moderation in the intensity of the expected impact of the policy initiatives. However, some of the policy initiatives must be sustained over a reasonable period of time to see positive result in the medium to long term. So it's also a demerit to have, frequent, changes in policy initiatives. You allow things to fizzle out. There's a lag effect of policy impact. So your assessment period also is important to be able to know how impactful is your policy initiative, so that you don't overheat the system or you don't distort the outlook or the expectations of your initiatives. In terms of the projections, yes, it's sensitive to be conservative in some places. It's also important to be bullish in some places. It depends on what are the low-hanging fruits. What are you supposed to look at? For the Central Bank of Nigeria, issues relating to managing FX demand substantially are more or less like low-hanging fruits. The other side of managing the supply is something that is somehow beyond the buffers of the Central Bank of Nigeria. And we need to coordinate with other internal and external stakeholders to be able to address that. But for the long-hanging fruits, and we need to be, a bit more proactive and also, well-targeted, well-focused. And that's why you see, governor emphasizing on some of these arbitrages that you see in the system. These are behavioral activities that distort the expected market behavior. And when you find those kind of things, you can nip that in the bud immediately. And so you address that. So, and then you see central bank getting into issues of moderating how, these excesses and speculative activities are done, so that they don't distort the expectation of the exchange rate market. Because we see substantially those are the things that really find to be more disturbing than the interplay of demand and supply in the market.
What will likely change in terms of monetary policy in 2020-2021?
Well, we are in an easing mood now, expansionary in the sense that the last two previous MPCs, the MPR rate was reduced by 100 basis points to stimulate growth in this crisis period. As the growth numbers pick up, we have seen PMI, picking up now. We have seen global growth also picking up gradually now. We still have the challenges of inflation numbers still above our threshold. So we need to moderate that with some of our monetary policy tools. But like I said, the monetary and fiscal space are thinning out. So we need to be very, very innovative in the way we handle these things. The expectations are still that, well, the policies that are working or the initiatives that are still impacting positively on the system will be sustained, enhanced, and strengthened. And the collaboration between the various stakeholders in the economy is critical now. The coordination is critical. We can't be moping and then we're also spending simultaneously at the same time. We have to have, fiscal prudence and also have, moderations in our monetary policy impact on the system.
So what will likely change in terms of exchange rate management in 2021, Dr. Hassan?
Well, what will change will depend on how the market changes. And so it's not possible for me to say that, okay, in October, exchange rate will be this. No. But it depends on the behavior in October. Whatever happens in that behavior will be the policy initiative will be a function of that behavior to address that immediately, particularly if it's going to be distortionary on the part of where we want the markets to go in terms of stability in the exchange rate market. So
would there be a further harmonization of exchange rates?
Are converging? Of course, if it is necessary, we have to do that. So now we are seeing a moderation, a convergence of the rates, which is also making the market a lot more stable and a lot more transparent, in the sense that if you want to do your big transactions or formal businesses, you go to the I&E window. And so long as the central bank and the other players in the system, the operators, the banks, are able to provide that liquidity in the market, then you see normalcy coming into the market. But when we still find abnormal outlier behaviors in the system, then definitely, those will be addressed immediately. And the policy outcome of those ones will determine, what you can call the next points of central bank monetary policy behavior in terms of exchange rate management.
Dr. Hassan Mahmoud, Director of Monetary Policy at the Central Bank, thank you so much for your time today. See you on the show some other time.